Welcome everybody to Teaching Tuesdays. We are back and we are excited. So this is the second Teaching Tuesday from the new series. So welcome everybody. For those of you that are not aware, Nicole Amundsen, who's on here now, started buying commercial real estate. Is it 30 years now, Nicole?
I started buying real estate about 30 years ago, but it was another 4 or 5 years after that before I bought my first commercial property, my
So a
first apartment.
measly 25 years in commercial real estate. She started teaching about a dozen years ago, and I took her course about 10 years ago. We got Alex took her course. Natasha just decided to take the course. There's a couple of other students on here as well. So welcome everybody. The course is phenomenal. A lot of great success stories coming out of it. And this is a little bit of a, I guess, well, Teaching Tuesdays, right? The opportunity to kind of share some wisdom in terms of being successful in multifamily from a lot of different perspectives. And today we're going to be talking about cost segregation. Alex, that has been a student and a friend for a very long time, has had great success, lives in Maryland, buys in Maryland, buys in Baltimore City, and a couple of other
little bit.
places as well, is going to share with us today about cost segregation, all the advantages to you as a real estate investor, and all the wonderful things you can do, whether it's multifamily or single family, right, Alex?
Um, yeah. I mean, whatever property, whatever non-property that you don't live in,
Okay,
that's
awesome.
meant
All
for
right.
investment, commercial purposes. I think you can even buy a property for your business and cost seg it. Like if you were, I don't know, if you needed a bakery or auto mechanic shop or something, as long as it's not, I think, I don't think it
Okay.
just applies to rental property. I think I,
I think
I'm
that's true. I
out.
think that's true too, Alex. I think you're right.
As long as you don't live in it.
Yeah, it has to be income producing.
Correct.
Okay, awesome. So we'll just go ahead and get started. We'll spend about an hour together and then answer questions, and then kind of go from there. So, Alex, sir, it is all yours.
Thank you, sir. All right, let me see. This is my first time doing a PowerPoint share since I was in high school 25 something years ago. So bear with me, please. If I screw up, just tell me. All right, hold on. Oh, first I gotta hit share, share screen, share. All right, present. All right, does everybody see a screen? It's got like a greenish background.
Yeah, and there's some young guy on there. Yep,
Yeah, that picture was just taken yesterday.
I can tell. Nice tie.
Perfect. Before you guys got on the call, they were making fun of my tie in the picture. They said it dates the picture. And I don't know why. I haven't worn a tie in a while, but that probably is why it dates the picture and not the style. Um, what is up, everybody? My name is Alex. I've been a real estate broker for the last 23 years since I was 18, maybe 24 years now. Um, I sold real estate through college, through undergrad, through grad school, and I stuck with it. I started buying properties when I was about 21. The first couple didn't work out that well, and then I kind of got back into it around 2009, into buying. So at first I bought about 30 something houses as rentals, and I wanted to figure out how to scale up. I wanted to know about apartment buildings. I took Nicole's and James' class in 2017. And then I bought my first multifamily property on December 31st, 2018. And the December 31st date really, really, really matters because I was able to do a cost seg study and apply it towards my 2018 taxes, even though I had only owned the property for a few hours in 2018. And getting a closing done on December 31st when everybody's trying to party and take off and not work is challenging, but we pulled it off. So anyway, this is something I heard about cost seg the first time when I was on an airplane flying somewhere, and I was listening to an accounting podcast because that's what I like to do in my free time, listen to accounting podcasts. And they were talking about cost segregation and bonus depreciation. And I was like, what the hell is that? And I figured out I never liked giving too much money to Uncle Sam, and I figured out that if I buy real estate and do cost seg studies and bonus depreciated, I can offset my earned income from my brokerage work with cost seg. So this is near and dear to my heart, and I love it. It's like my little something that I deeply care about. So anyway, let's get started. I put together this presentation. Thank you, Nicole and James, for graciously letting me host this presentation. It's basically, and also, can everybody hear me okay? Yeah, all right,
Yes.
awesome. This is tax strategy, so it's not super simple, but I tried to make this beginner friendly and keep it to about half an hour and update it with the latest and greatest information from the new tax code. But just so you know, we're not tax professionals, we're not attorneys. This is not legal advice, this is not tax advice. It's basically, how do you say it? For entertainment purposes only, or education, or entertainment, or a little bit of both. But consult your lawyer, consult your CPA before you implement anything. So we'll cover the basics of how depreciation works in real estate, what bonus depreciation is, who can use it to offset their taxes, what cost segregation is and how it works with bonus depreciation. We'll go through the numbers on a few examples, what to look out for, and kind of the pitfalls also, because anything that the IRS giveth, it takes away as well. So there's a few little pitfalls and some strategies around that as well. So basically, depreciation is a paper loss. It's a paper expense. It's not a real expense that you take. You cannot depreciate. So you buy a property and say it's $100,000, just for simple math. You can't depreciate the land portion of it. You can only depreciate the structure portion of it. So by doing cost segregation, you bring more depreciation up front versus spread over the whole time, and it lets you lower your income from that property, and possibly it could let you lower your earned income from other sources. So what is depreciation? And I'm just going to read what I have on the slide. The IRS treats a building as something that wears out. Basically, so you get to deduct a portion of that value of the building every year. One important thing, and this thing gives me a laser pointer, which is pretty cool. This is my little laser pointer. Land does not depreciate according to IRS. So you can only write off the value of the building, not of the land. You can, in your cost seg study, you can dictate what the value of the land is, but you can't write off the land portion. So the more that is assigned to your building when you're doing depreciation, the better, and the less that's assigned to your land, the better. So say you buy $1 million commercial property. As an example, $800,000 is attributed to the value of the building, $200,000 is attributed to the value of the land. You can't depreciate the $200,000 land, but you can depreciate the $800,000 building. Is everything I'm saying so far making sense? Please stop me anytime with questions. I don't see the little hand thing as it pops up, so you can just speak and interrupt. James, can people talk?
Yeah, absolutely.
You
So
have
I
to
was going to
unmute
say
them.
we have a small enough group that
Yeah,
oops, sorry. We have a small enough group that if you have a question, just feel free to unmute. I don't think we're going to disrupt anything. You should be good to go. So does that work for you, Alex?
that's perfect.
Okay.
That's perfect. Yeah, because if somebody raises a hand, I don't think I'm going to see it.
Okay.
Looking at 3 screens right now. You're on my screen to my right. My guide to my slides is on my left, and then you guys see what's in the middle. So I probably won't see a hand. So just interrupt if something doesn't make sense. Okay, so the normal way to depreciate is standard straight line depreciation. So when you have residential property, you depreciate the value of the building over 27.5 years. When you have a commercial property, you depreciate it over 39 years. However, to the best of my knowledge, apartment buildings, no matter how many units, actually fall under residential property. Even though a lot of times people say 5+ units is commercial, I believe the IRS still treats it as residential, so you get faster depreciation. But if you had like I don't know, like a Walgreens or a retail strip center or a warehouse, or something that people don't live in, you got to depreciate it over 39 years. So
Alex,
yes,
question.
yes.
Why do commercial properties fall under the category as residential, quote unquote, when it comes to depreciation and not?
Why do
What's
they?
the why?
Why does the IRS think they last longer?
Yeah, you just said that
Um,
even though it's a 5 unit or more residential property,
oh,
it's still considered. I mean, commercial property still considered residential.
I believe because people live in it.
Okay.
And I would I would double check that, but anytime I've done a cost seg study on apartment buildings that were 5+ units, anything that I couldn't write off up front, they still put it over 27.5 years. I don't know why the IRS thinks that commercial properties last longer than residential properties, but that's just an IRS, whoever, I don't know why they think that a residential property lasts exactly 27.5 years, why that's
Mhm.
the lifespan. But, whoever wrote the IRS code determined that. Um, that's a very good question. I don't know the why.
Okay.
And I
Thank
don't
you.
know if they know the why either.
They probably don't. Oh,
It's
this is
probably
Natasha talking, by the way. Didn't introduce
Natasha,
myself. Yeah.
pleasure. Thank you. But yeah, in terms of like, I think 5+ units apartment still falls under residential. Um, all right, so what is cost segregation? It's basically an engineering company coming in and taking your building and splitting it up into different buckets. So the IRS thinks that things last either 5 years, 7 years, 15 years, or 27.5 years. How they came up with those buckets, I have no freaking clue. But basically, the IRS takes everything in the building and drops it into one of those buckets. The thing with bonus depreciation is anything that falls in the 5, 7, or 15-year bucket, you can actually, with a cost seg study, depreciate in year one versus waiting the 5, 7, or 15 years. So you got a big upfront depreciation benefit with bonus depreciation. Does that make sense? Cool. All right, so what falls under each bucket? Carpet, appliances, decorative lighting, certain fixtures. Now, flooring, the interesting part is if it's glued down, it actually moves to the 27.5-year bucket. If it is a floating floor like a carpet or an LVP that is not glued down, it stays in the 5-year bucket. Why that is, I have no idea, but that's how they classify it. So if you're not sure, it's better, if you're doing cost seg study and you're selling flooring, it's better to have flooring that is a floating floor versus glued down. Furniture, equipment, AC units, heating units, boilers, things of that nature, fall into 7 years. Things like parking lots, fencing, landscaping, parking lot lights, things of that nature fall under 15 years. And then the actual shell of the building is either 27.5 or 39 years, per IRS. And if you Google this, there's a lot of tables with like more of what falls under each bucket. But typically in my cost seg studies, and I can go through a sample one later, but typically about 25 to 31% was depreciated in the fast buckets based on what I've seen. I think the industry average is like 20 to 35%. I've usually seen, I think 26 to 31% is kind of the band that I was typically in. Any questions on this?
So is that 25 to 20, 30, 25, 20 to 35% of the
Bill,
entire cost or the cost minus the land?
it's always the cost minus the land. The land doesn't count. Now, you can give the cost engineering company your land comps because a lot of times they'll just attribute maybe like 20% to land. But if you can show with data that the land is worth less, like we've shown land value as low as 5 and 10% because I had comps of land to support that. So usually if I think they're valuing the land too high, I'll give them comps to show the land at a lower price. And I usually work with a company called Engineered Tax Services. And I've asked them if anybody's ever gotten audited on the value of the land. And they said in the thousands of reports that they've submitted, they've never had anybody come back saying they got audited for what they wrote for the land value in their cost seg study. So do your homework on that and try to get the land valued as low as possible in your cost seg study, because that gives you a bigger write-off for everything else. Does that make sense?
Yes.
Cool. All right. So what is cost seg? Or what is bonus depreciation? So bonus depreciation is basically anything that has they call it a recovery life or a lifespan of 20 years or less, which is the stuff that falls into the 5, 7, and 15-year buckets, you get to depreciate in year 1. So the shell of the building doesn't qualify, but a lot of the stuff inside does qualify. It doesn't have
Alex,
to be. Yes.
sorry, I have another question. What
ahead.
is the advantage of depreciating it year one and not doing it
So we'll
over, let's
get to
say, 3 to
that.
5 years? Oh, okay. My
We'll get to that.
apologies.
No. So if you're a real estate professional or if you have another job, but you qualify as a real estate professional, or if it's a short-term rental, you can use it against your earned income, meaning your income from another source, like your regular job.
So essentially, it's just a tax advantage that you're paying less
Yeah,
taxes.
this whole thing is basically a tax advantage.
Okay.
But it's a tax advantage that because I've been buying real estate, I haven't paid taxes or a lot of taxes on my
Properties.
income from being a real estate broker since 2018.
Got it. So has there ever been a time
Yes, sir, go ahead.
where you've had a property, whatever the unit count is, and you've said you're not going to depreciate the cost year one, you're going to delay it and depreciate year 2 or year 3?
All my like little properties that I bought, like the single individual units, to be honest, I haven't run cost seg studies on them. Reason being is because I didn't even really need the deduction because I got deductions from the bigger properties. But I think if I didn't have those deductions from the bigger properties, yeah, I'd be running like I had a friend, he had 15 rentals. And he had a really good income. He did sales for government contracting companies, and he was making about 600 grand a year doing those sales. And he basically wiped out his entire tax bill by doing cost seg bonus depreciation on his 15 rentals. So he didn't pay the $200,000 plus in tax that he would have paid otherwise.
Yeah, I was going to say, you saved a lot of money.
Yeah, exactly. But it doesn't apply to everybody. Like you can't use it against, not everybody can use it against your earned income, and we'll get to that and some of the kind of nuances of that. Does that answer your question, Natasha?
It does.
Cool. All right. So, in 2017, I think in 2016 or 2017, they came out with bonus depreciation, but it was supposed to start phasing out in 2023. where you can at first take 80%, then 60%, then 40%, then 20%. And then the new big beautiful bill reversed that, and now you can depreciate 100% again. It made it permanent, and I say permanent in quotation marks because, you know, a new government comes in a couple of years, and whatever the previous government made permanent, they could certainly wipe out and make it unpermanent and go back to the other structure. But at least for now, it is quote unquote permanent, here to stay for now. Which means you can use it again, because by the time it got down to like 40%, 20%, it wasn't as useful anymore. So here is what happens. You buy a property and put it in service. By putting it in service, it means advertise it for rent, rent it out, treat it as an investment property. You hire an engineering company to run a cost seg study. They break the property up into 5, 7, 15, and 27.5 year buckets. And I'll show you an example later of what a cost seg study looks like. And then anything that goes into these buckets, you get to write off in year one. And whatever write-off you can't use, you get to carry forward. So here is an example with $1 million property. We're going to say it's $1 million apartment building. $200,000 is the value of the land. $800,000 is the value of the building. And we're going to say that 30% of it is the shorter term buckets, the 5, 7, or 15-year buckets. If it's regular straight line depreciation, you get about a $29,000 year one write-off. With cost seg, you get a $260,000 year one write-off. So in essence, if you qualify to use this against your earned income and say that your earned income was the same or less than your write-off, you'd pay no federal income tax. So you basically maximize the deduction by quite a bit. Does that make sense?
Yes.
Yes.
Cool. All right, so let's say that you had this $260,000 write-off, and let's say your top marginal tax rate is 37%. That means you pay $96,000 less in taxes that year, which you can use to buy more properties and to cost seg more stuff and to pay no taxes going forward, which is like half the reason I like to buy real estate. Okay. So this is kind of the thing to pay
So
attention
can you
to.
back up for a slide for just a minute, Alex?
Yeah.
Okay. So where does this 96,000 come from? Is that 37% of the number
260.
before, or is that the year one? Is that what your tax would be, and then you have some left over for the next year?
Yeah, so this is kind of how the numbers get derived, right? $1 million property, $200,000 of land, 800,000 value of the building. Let's say 30% is shorter lifespan items within the building, which 30% of 800,000 is 260,000, right? So if you multiply 260,000 by a 37% tax rate, that basically is how much you save in taxes. Now, if you can't use that whole $260,000 deduction in year one, you carry it forward until you can use it. So say somebody had $100,000 earned income when they were a real estate professional, and they could apply this, then they couldn't use the whole $260,000 write-off, right? Let's say their $100,000 income stayed the same for the next 3 years. So in year one, they'd use 100,000. In year two, they use 100,000. In year three, they use 60,000.
So basically, rather than paying Uncle Sam $96,000, you get to keep $96,000 to buy a boat or reinvest, hopefully, in more real estate.
To do whatever.
Right. No, it's awesome.
Spend it foolishly, as all of us real estate investors
Don't.
don't do. Yeah, exactly.
So talk about this second little bullet. Maryland and DC don't allow bonus. You add it back.
Yeah, so basically this is off your federal. Every state is a little different. So your state taxes are still going to be based on your pre-write-off amount, right? So if your state taxes are, I don't know, 6%, 7%, 8%, whatever Maryland state taxes are, you still have to pay that 6, 7, or 8% on your earned income. But you don't have to pay the federal, and the federal is the big kahuna. So this is assuming a 37% top, top marginal rate on federal. And then of course you have your state taxes. Some states I think do allow bonus to go against your income. Some states don't. But in this case, Maryland, at least Maryland and DC don't allow it. Does that make sense, Nicole?
Mm-hmm.
So you might still have some you will, even if you are able to use this, you'll still have some state taxes.
If
All
you
right.
live in Maryland. Nya, 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 nya.
Well, I don't know about Florida. I have not researched Florida. I will look it up and let you know.
Florida
But
doesn't have any state taxes.
I'm very happy for you. I can't leave. I'm a prisoner of Maryland.
I know
Right
you
now.
are. I
At
know
least
you
for the
are.
next, I don't know, 13 years. In 13, 14 years, there's a good chance I'll be somewhere else, but I got a little runway to be here. All right. Nicole's favorite state is Maryland, by the way, if you guys didn't know.
I think all of our properties in Maryland, isn't it? Isn't that right?
Yeah. Yeah. She's actually selling everything everywhere and moving into Maryland.
That's what I heard.
Baltimore City.
Oh my
Yeah.
God.
It's got to be one of those AI things where you just can't believe what you hear.
Ooh.
And DC. She
And
loves
DC is worse than
regulations.
Maryland. Yeah, yeah. So of the 12 states I have property in, Maryland is my 12th favorite.
We got to get you into DC. Maryland will move up one spot.
Oh, well, that's probably true. That's probably true.
By the way, speaking of DC, as of today, everybody has to go to Palisades Deli and buy a breakfast sandwich because they're now my tenants and have to pay rent. So go to Palisades Deli on MacArthur Boulevard and buy a burnt cold coffee or a couple-day-old breakfast sandwich so they can pay me rent, please. Thank you.
Okay.
That's a hard no for me, sir. That is not a
But
good
I know
selling
exactly
point
where
at
that
all.
is. I've driven past that deli.
Really?
Yes.
Well, we're now officially as of 5 p.m. today. We're now their landlord. They don't know it yet. We're going to send them a letter tomorrow morning.
Congrats.
But they got to pay rent. Their rent's $4,000 a month, and they got to pay up. So, okay. Sorry, digress. But I got to put in my plugs. All right. Rental losses. Also St. Mary's Fine Wine and Liquors in Great Mills, Maryland. They don't actually sell any fine wine. They sell boxed wine. But please go there and shop. It's across from a Sheetz gas station.
At the on the last slide, Alex is going to have links to all his
I'm gonna have
commercial
links,
properties
yes,
for
to
you
my
to go and
tenants.
support them.
I've got a hair braiding place. They need some business. James, you look like you need to get your hair
Yeah,
braided.
I'm there.
Yeah, you got to grow it out.
There you go.
I'll get you the first braid half off.
Nice. I'm there.
All right, love it. All right, so by default, rental losses are passive, even if you're actively involved. And I'll explain what that means in a minute. By default, rental losses do not offset your W-2 or active business income. By default, they carry forward until you have passive income. So the question is, can I use this loss that this cost seg study generated against my other income, or only against future rental profits? And there are two paths to use it. The first path, because you get this nice loss, and now you got to figure out how to use it. The first path is the real estate professional status. If you qualify as a real estate professional, and I will let you know what what that entails in the next slide. If you qualify as a real estate professional, basically it's REPS status with the IRS, you can use this loss to offset any other income that you have. The test is the 50% test. More than half the hours that you work are in the real estate or real property business. And that could be management, brokerage, development, being a landlord, whatever. As long as it fits under the real estate bucket, more than half of your working hours have to be in real estate, and you have to spend at least 750 hours a year, which is only like something like 2.3 hours a day in real estate. And you are involved, material participation. It's a checkbox on your tax return. You're actively involved in running them. The reality is, if you're a full-time W-2 employee and your pay stub says that you are working 40 hours a week in that job, it's hard to say that you spend more than 40 hours a week in real estate. However, if you're married and you file a joint tax return, only one person in that marriage. What's up, Ioana? I see Ioana.
Hola, oh, you see me.
Hola, 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 ¿cómo estás? Buenas noches.
Buenas noches.
All right. So, Ioana is a real estate professional. Even though she has another job, she spends more time in real estate than in her other job. So if you are married and one person can pass this test of spending at least 50% of their working hours and at least 750 hours a year in real estate, you get to deduct it against both of your combined incomes. So if you have a spouse that's sitting around, make them a real estate professional, and then you can use this income. I've had a few clients where their spouse was a stay-at-home person, and they started, with a few rental properties, buying properties, and now when they buy properties, they can use cost seg to offset the other spouse's income, and it's been fantastic.
Alex, I have a question on the, so for extreme clarity, that's a couple that's married and they're filing jointly, or is it applicable to a couple that's married and filing separately?
So Natasha, I have to preface this by saying I'm not an accountant. Check with your CPA, but my understanding is you have to be married and filing jointly. The income has to fall on the same tax return, is my understanding when I asked my accountant.
Okay, that's what I thought. Thank you.
Thank you. Thank you for asking questions.
No problem. I'm gonna keep them coming.
Let's go. Let's do it. All right. Okay. So this is one way to do it. And there's a second way to do it, which I recently learned about. My clients actually taught me this. The second way is the short-term Airbnb, VRBO, short-term rental angle. So if you have a property and the average stay is less than 7 days, it basically sidesteps the passive rental equals passive income rule. And you just have to be the one actively running that Airbnb short-term rental. I think the abbreviation for short-term rental is now on STR. I now have my first Airbnb, and I'm learning a lot about STRs and all the abbreviations. But if you have a short-term rental, you do not need to meet the 750-hour test or the 50% test. You can use that short-term rental and offset your W-2 or ordinary income with the loss from the Airbnb. So a few of my clients, they went out, bought some properties in Ocean City, Airbnb'd them, managed them themselves, and did a cost seg and applied it towards their income. And these guys were doctors, they were making good money, and they needed some good tax deductions. So this is what they used for their tax deductions. So this is the second angle, is if you have a short-term rental, average stay less than a week, you can cost seg it, take the loss, apply it towards income from another job to reduce your taxable income. So, does that make sense?
It does. Can you go back to the last slide?
Sorry, and I can send this too, if you want me to email it or share it or whatnot.
Okay. All right, thank you. You can move forward. I was just reading that last
All
part.
right, cool. Yeah, Natasha, if you're meant to like email this out, or James has a copy, he can circulate it if he's got everybody's email addresses.
Sure.
All right, so 3 examples. Let's say you have 2 people filing a joint tax return. One person qualifies as real estate professional status. Household income is 300,000 between the 2 of them. They can use that $260,000 write-off, save 48 grand on their federal income tax, and carry forward the loss for future years. So they could write off, they can basically pay no federal income taxes for a few years by buying that rental. And that savings will probably, when I run my numbers, my cost savings from cost seg pays for half of my down payment. So I'm basically getting into my properties for half the price because of this. And otherwise the money would go to Uncle Sam, and we all know that they spend it very, very, very wisely and are doing a great job keeping our deficit down and paying down debt. And they're incredibly, financially careful. But you can send the money to the IRS if you want. All right, second example. Somebody has a $120,000 a year W-2 job, single individual. They buy an Airbnb. The Airbnb has an average stay of less than 7 days. They use it. They write off $17,000. They save $17,000 a year until they make up that full, until they write off the full $260,000 deduction, which will take them a few years. Now, where it doesn't work, let's say you got 2 people, high income earners, both have a W-2 job. They don't have any Airbnbs. Neither of them can qualify as a real estate professional. They cannot use it against their ordinary income from their W-2 job. They can only use this loss for this rental or other rental properties, basically other passive income. They can only use it against a passive gain down the line. So for them, it wouldn't work. You got to either have somebody that qualifies as real estate professional or do it as a short-term rental.
Now
sorry.
the depreciation though for the 27 and a half years still applies. You can still
Yeah.
use that depreciation.
Well, yeah, but you can't use that depreciation. But if because of that depreciation, you get that property shows a loss, you can't use that loss against your earned income. I think you can use $3,000 of the loss against your earned income, but say you're making 100 grand a year, 3 grand loss ain't gonna put a big dent in your income.
So Alex, what happened? I'm sorry, go
You
ahead.
can use it against the income of the property, so you'll pay if that property is making money, you'll pay less taxes, but you can't use it for other stuff.
So let's say someone that is a single family investor has 20 houses, but they have a regular W-2 job, and they go, oh, wow, this sounds awesome. They go out and they get a short-term rental. Can they then deduct all of the income from their 20 houses?
I think, yeah,
Because
because
now they
20
are
houses
considered
count, 20 houses count as passive income. Yeah, I think they can.
so you can have one short-term rental and basically
Well, no, I
involve
mean, if they have
all of
20
your
houses,
income.
they count as a real estate professional. They have a W-2 job or they don't have a
They
W-2
do have a
job.
W-2 job, but they have 20 houses.
Okay, so if they have 20 houses, I think they could probably pass for the real estate professional status.
But if they have a W-2 job, they can't
Why not? They got
because
20
they
rentals that they're managing. They could say, hey, I spent 20 hours in my W-2 job, but I spent 30 hours managing these rentals. These individual rentals are a pain in the butt to manage. They take time. Tenants are always complaining. They always have something that's breaking, toilets that are clogging, appliances that are breaking. They're always like having domestic violence, not, the boyfriends
so
and girlfriends are always breaking up. Like it takes a lot of effort to manage 20 houses.
so I've heard. Talk to you, Anna. But anyway, I thought you said that if the IRS says, "Oh, look, you've got a W-2, therefore we're not going to let you do it because we know
Well, the
that."
W-2, it depends what the W-2 says. The W-2 says that you work 40 hours. I feel
Uh,
like somebody with 20 houses, they could say, hey, I'm working even more time in this. It just
right.
has to
Okay.
pass the step test.
Right. Okay.
But if
All
they're
right.
a
Cool.
W-2 job, like I've got buddies that have W-2 jobs, they're probably working 2, 3 hours a day in their W-2 job,
Right.
and they can show that and document it and log it and then say, hey, but if somebody is like a dentist and they're seeing 15 patients a day,
Right.
then and they have 3 rentals, they're probably spending more time seeing patients than they
Right.
are.
Okay. So you just have to. So in terms of your earlier slide, they just have to be able to document it, basically. Even if they
They
have a
basically have to
W-2 job, it
document that
doesn't
they're
knock
doing
them
more
out.
time in real estate than they are in whatever their other job is, and
Okay.
that the time that they spend on real estate is at least 750 hours. But
Gotcha.
to answer
Okay.
your other question, yes, I think if they have an Airbnb and they have 20 other houses and a regular job, the Airbnb, they can apply that loss across whatever their earned income is across the board. Because
Wow.
now it becomes an active loss, they can apply it towards any active income.
Right.
So now how does having property management manage your properties and you have a W-2 fit into all of this?
Well, I think it's the same thing. You can have managers or help, but you have to show, the best way is to have logs. You have to show that you're spending more time
Yeah,
in
that's what I was
with
thinking.
your investments than you are in your W-2 job.
So
Or
your
get
20
married to somebody that's not doing anything and have them work 750 hours a year in real estate.
so your 20 houses that are managed by a property management company, it can get kind of sticky if you
I think
can't.
it gets stick. I mean, I think it gets sticky. I think that,
But so the key is you really need to have some kind of evidence.
documentation. You have
Yeah.
to have documentation that you're spending more time doing the real estate stuff than you are doing whatever else makes you money.
So now let me ask something else. I don't think it's in your slides. Somebody has bought 20 houses, but they've been holding them or they bought them 5, 6, 7, 10 years ago.
Yeah.
Where does it fit to go back in and retrospectively get a cost seg
Cost
study?
seg study. So you can go back and get cost seg studies. I just had a buddy of mine do it. I mean, he's been buying houses for maybe 6 or 7 years. He went back on all the houses and did a cost seg study. But I think once you've held a place like 10 or 12 or 15
Yeah.
years, you were probably already depreciated a lot of it. So at that point, you're depreciating less because you've already taken a big chunk. But I'd probably say if you bought it in the last 7 years, it still makes sense.
Thank you.
Thank you. Great question. Keep them coming. All right, next. You guys ready for the next slide?
Hmm.
All right. So here's the other thing is if you are single and you want a tax deduction, marry somebody who is lazy and doesn't have a job. and give them a job, and they only have to work like 2.6 hours a day in real estate. Hold on, I got to do this math. What is 750 hours divided by 365? They only have to work 2.05 hours a day to qualify.
So now you're
And then
giving
you get a
marriage
lazy
advice?
person.
You get
You get a lazy person in exchange for a tax deduction. It's not bad. You got to weigh your pros and cons.
It's amazing, you know, teaching Tuesdays, we give you everything. Real estate
Yeah, right.
advice, marriage
Relationship
advice,
advice.
relationship
Well,
advice, whatever you need. It's all here.
there you go. I would consider it. I don't know. If I was getting married again, I would say, I got to have some tax benefits out of this. Love is not enough.
And you need a good prenup to go along with
Oh
that.
yeah. 100%. Yeah, that's another good piece of advice. If anybody gets married, get a prenup. It's very expensive without it. All right. So, wait, did we go through this one?
No.
Okay, sorry. So, okay, one person is a bum that stays at home and does nothing, but you give them a job. You say, okay, you're going to manage my 20 rental properties. Get off the couch, do some management, get us REPS status. And let's say that the spouse is a brain surgeon and needs a tax deduction. And the other spouse didn't have a job, but you give them a job. That person now gets REPS status. And in this example, their household income was 300,000. They buy $1 million of rental property. They get a $260,000 deduction. Their federal tax bill goes from $49,000 to 744 bucks. They save 48 grand. Next example. Let's say you have an Airbnb. You make $120,000 a year from your other job. You cannot qualify for REPS status. You buy a $500,000 cabin as a short-term rental. Qualifies as a short-term rental. You get about $120,000 first year write-off. So you buy that cabin, you pay, let's say, I don't know, 100K as your down payment, maybe less, maybe buy it with an FHA loan, I don't know. But before on your $120,000 income, you're paying about 17 grand in your federal taxes. After you run this cost seg study on this cabin, you pay zero. Here's some notes on maximize. By the way, do the two examples make sense?
Yes.
Cool. Couple
Can I
notes here.
can I ask a question, please?
Yes.
Yeah, after doing the cost segregation on the property, do you have to hold it for a certain period of time, or does it matter when you sell it?
It does. We'll get to that. If you
Okay.
sell it and you don't 1031 it and you don't exchange it for another property,
Capital gains
IRS
taxes.
claws it back. Whatever you gave them, they come back and they say pay up.
Mhm.
They claw it back at a recapture rate, which is usually lower than your regular tax rate. So there is some tax savings, but you can actually end up with a higher tax bill that way because there's something called recapture depreciation.
But you're going to talk about that in a little bit.
I'm going to talk about that in a little bit. So obviously, if you can qualify as REPS or as a short-term rental host, it makes sense to do the study or buy a property and do a study in a year where your income is higher. But even if your income is not higher, you carry forward that loss to a year that you could use it. Hiring an engineering-based real firm probably makes more sense than using ChatGPT for your cost seg study. It's just more defensible. I'll share what I get back from my cost seg company. I'll show you a sample report. It'll probably hold up better. The company that I use actually will provide IRS audit defense. They'll help in the case of an audit. I'm not sure if all companies do it, but the one that I use does. And that probably will hold up much better if you ever get audited. If you never did a cost seg study, you can go look back. You can basically do a look back study and take the depreciation that you missed. But then if you owned it for 10 or 15 years and already took a lot of depreciation, maybe it doesn't make sense. So the other thing, if you replace stuff, you can do a partial asset disposition. You can write off the remaining basis of what you tore out. Basically, a cost seg study lowers your basis. If you sell the property, there's something called recapture depreciation. By doing a 1031 exchange into another property, you basically avoid having to pay that tax. And of course, look at what your state income taxes are going to do, because the bonus depreciation may not affect your state income taxes, only your federal, depending on what your state rules are. So 3 words to know: basis, gain, and recapture. So a basis is what you have invested in the property. When you start depreciating it or bonus depreciating it, it lowers your basis. When you sell the property is your gain. So it's your sales price minus your expenses minus your new lower basis. So if you take more depreciation, it means a bigger gain down the road if you have to pay taxes on it. And one thing to look out for is recapture depreciation. So say that you have your $1 million property, you take $260,000 of depreciation, your basis drops to about 740,000. You sell it for $1.1 million. Your gain now becomes 360,000 instead of 100,000. So you're paying taxes on that $360,000 if you sell it, because it's your recapture it's your depreciation that you took plus your capital gain. And the ways to avoid that is by doing a 1031 exchange or leaving it to your heirs when they inherit your property. So like I plan to hold all my stuff until I die and then have my kids inherit it. Their basis resets. It's called step-up basis when I'm no longer around, which means they inherit it at whatever value the property is at the time that I die. So that means if I bought a property for $200,000, when I die, it's worth $1 million, and I depreciated the whole thing, and I die, it's worth $1 million. Their basis is now $1 million, so all that tax gets wiped off, which is pretty cool. Or you can do a 1031 exchange. And another thing to keep in mind is, yes, you don't realize the profit when you're not selling the property, but you can always borrow against a property and use that money for whatever you want, because borrowing money is not a loan is not taxed as income. A loan is basically not taxed. So if you have a property, you depreciated the whole thing, it's now paid off, you can borrow against that property and spend that money on whatever you want, and that's not taxed. Just make sure you 1031 that property, otherwise you'll be paying recapture. And recapture, as long as you kept it over a year, recapture is basically at the standard capital gains rate, which I think is between 15 and 25%. So if you're in a high tax margin, you can actually, even if you buy a property, cost seg and bonus depreciate it and sell it 2 years later, you might have saved 37% on the original tax write-off and only pay taxes on 20% of the recapture, because its capital gains rate is usually lower than your earned income rate. So there is some benefit even if you sell it, if you're in a higher tax bracket. Does that make sense?
Excuse me a second. Hey, James, I sent you a message in chat.
Okay.
Thanks.
Okay.
I'm gonna have to leave.
All right, Lewis. We'll
But
talk to you
thanks for the
soon.
information, everybody. Thanks.
Lewis, good talking to you. All right. Some things to watch out for. Recapture. We just talked about recapture. Once a property is like $500,000 or less, sometimes the fees kind of eat up the study. I'd say like if it's less than 300,000, sometimes it might not make sense to run a cost seg study unless you can get an inexpensive one done. But we'll do an example later on a $300,000 property, just see how it shakes out. And here is what,
Alex,
yes.
how much do cost segs typically run average?
So on my apartment buildings, I think I've paid like 5,000 to 7,000 per study, and it's a pretty detailed study. When I just had my buddy do it on 15 houses, I think he paid like 2,500 bucks a house.
Okay. So it's contingent upon the property type
Um,
or portfolio
yeah, because in a
size?
apartment building, there's more for them to look at. The study's a little, more dense than on a house. But also I think like for him, because he was doing a bunch of properties at once, they brought the price down. Now, when I was shopping for a cost seg company, I didn't shop for the lowest price. I shopped for the people that showed me that they could give me the best,
The best work. Yeah.
the best work, but also the highest percentage attributed to shorter lifespan items. And on the same property, I sent it out to like 10 different companies. And they ranged, I think, from like 21% being short term to like 34% being short term or like lower lifespan items. So I went with the company that was like middle of the road priced, but gave me the highest depreciation up front that they thought that they could defend. So that's what I kind of went off on. But I think you can, I've even heard of like software where you can do it for about 500 bucks and you do it yourself. I just don't know how audit proof that is. But it might be worthwhile to look into. So I have heard that you could possibly do it for as little as 500 bucks, where it's like a little bit of a do-it-yourself model. Obviously, the more reputable the company is, if you get audited, probably looks better.
Okay, thank you.
So basically, you're probably spending a few thousand, up to 6,000 or 7,000 for a cost seg study, depending on the property. If you could use the write-off, you get many, many times ROI in your tax savings compared to what you're paid for the for the study. We're going to do an example on a $300,000 property. So on a $300,000 property, we're going to assume 60 grand is the value of the lot, $240,000 is the value of the building, and 30% gets reclassified to short term. So on a $300,000 property, you get right off, assuming those numbers above, $78,000, which, if you're in the 22 to 24% tax bracket, gives you about an $18,000 tax savings compared to maybe like the $3,000 that you paid for the study. Save 18 grand by paying $3,000, you get a 7x return on your money. So it still seems to make sense even at like lower price properties. Nicole, you had asked me to insert this thing is if you buy a property using more creative strategies, like if you buy a property subject to, you hold the deed, the loan stays in your seller's name, you're now the owner of the property. Your basis includes the debt that you took subject to. So generally, yes, you can do a cost seg study based on our research on a property you bought subject to. Same thing with owner financed properties. Owner finance, they don't look at it any different than if a bank had the loan. So you can still do a cost seg on that. You sold the property on owner finance. You're no longer the owner of the property. Generally, no, you can't do a cost seg study on a property that you sold, even if it's on owner financing, because you sold the property. Does that make
So
sense?
one other I would add to this is if you have taken over payments, but so you don't own it, you don't have the deed, you've just taken over payments and then you have an option to buy it. As soon as you actually buy, even if you've been paying on it for 5, 7, 10 years, once you actually own it and have the deed, now the timeline starts again, and you should be able to cost seg at that point. So I
Right.
think the issue is when you get the deed, and it really looks like you are. So I think the key here is actually having the deed in your name as opposed to a lot of the more creative studies or creative ways. The deed stays with the seller for a certain amount of time, and that does not allow the cost seg until you actually get the deed.
Correct. Correct. Correct.
So
Correct.
all of us creative buyers out there, the key is the deed for cost seg studies.
Yes. Until you get the deed, you can't really cost seg it. Once you get the deed, you can. Nicole, good point. Couple things to remember. Depreciation is a non-cash deduction. You don't have to spend the money to take the deduction. Cost seg and bonus depreciation pulls future depreciation forward into the current year. It generally reclassifies 20 to 35% of the building value into lower lifespan buckets, and you can depreciate that all in year one. Bonus depreciation is now quote unquote permanent, at least while the current government is in power. It got made permanent in 2026, so if you can use it, use it. It only offsets income from other sources, aka your ordinary income, if you qualify as a real estate professional, or if you go the Airbnb short-term rental path. And you can do a look back study. You don't have to do it. You don't have to do a cost seg study immediately when you buy a property. You can basically look back at what you bought before and see if it makes sense for you to do bonus depreciation and claim it in this tax year, even for stuff that you bought before. And that's it. Questions? Is any of this useful? Will anybody try to do it? Is it confusing? Is it a bunch of tax mumbo jumbo?
No, I'm gonna use it.
Let's do it.
Yeah, Joanna, I was thinking you, particularly that house that you guys just recently bought, that can save you a whole lot.
Yeah,
Money to Uncle Sam.
our current tax individual, she's really screwed us over. Like
Yeah.
I mean, because Richard is learning about all of this and doing his due diligence too. He's the one that's telling her like, hey, this is what you got to do. I mean, she really doesn't know what the hell she's doing. And
Let me make a comment on that. I had a company that was charging me 5 figures for doing my tax return.
uh-huh.
And in 2017, I had to teach them about what cost segregation and bonus depreciation was. When I first called my accountant and I explained this, he was like, what the hell are you talking about? And I actually had to find the IRS articles and send it to him. And he's like, oh, yeah, that makes sense. So you're not the only one.
Yeah,
No,
it's ridiculous.
but so here's one of the things that this has come from, well, you've been at this a long time too, Alex, but half of your long-term success is your team. Um, and the quality of people. And so finding an accountant who really knows real estate and what you can and can't do, is one of the first team members I would really spend some time finding a good one. Somebody who really knows real estate. And we all know people who know real estate. So if you haven't found another accountant, Joanna,
but you
I
still
would
have
not.
to,
I did. I
absolutely.
already talked to James. I already talked to James. We're good. I just need to call him. But I mean, we didn't want to pay again because we already did the taxes. So I don't know if it's to our benefit to
Well, you
wait
can file
until
an amended
next.
return.
So Jeff Cohen of Katz Cohen will take a look at your return for free. And if he can save you a certain amount of money, he can show you where to do it. You can make a decision based on that, what that's going to do for you.
Okay. Thank you. I'll do that then.
The other thing is download this audiobook. It's called The Book on Advanced Tax Strategies.
But didn't we already have that one? Didn't we?
Okay.
I think
Did you
we
listen
already
to it?
did. Huh?
Did you listen to it?
Yes.
Good. I
James
love it.
got it for me.
Woo! It's by Amanda Hahn and Matthew McFarland.
Yeah, it's a really good book.
Cover.
It really gives you a lot of things like how to sandwich and do your taxes and what you need to do. So we're implementing all of that, and then I mean of course this is and James wasn't playing. I'm going through a headache right now with tenants. It's crazy. That's why he doesn't buy single family. That's why he buys multifamily. You don't deal with property management, or you could, contract your own property management. But when you're trying to learn the business, of course, you want to put your hand in the fire, right? And
Good.
and that's how you learn, right? Because when you get to that point or to that level and hire that property management company, then you already know what the heck they're doing right and what they're doing wrong. So
you gotta know you gotta know what's
but yeah, to your point, I need to do something. I'm gonna probably do that because she has to fix them again. The reason why this came about is because I don't want to make this about myself. If other people have questions, but is because we submitted our taxes to our loan officer that was looking so we can buy another multi-unit, and she said, "You're not. What happened to your duplex in West Virginia? It's not on your tax returns. You didn't claim it." I said, "Are you freaking kidding me?" So this lady is not doing absolutely nothing. Richard was the one that said, "Hey, can you please add the depreciation and the depreciation of the property," and telling her what we need to do. And so I don't know what to do because this is
Call Jeff. Call Jeff.
yes.
Call Jeff.
Okay.
Yeah, it's wild. It's wild. It's wild.
Yeah.
I agree. It's
You
a
know,
wild world. You got to teach the accountants sometimes.
if you've been in this business long enough, you make mistakes.
Yeah.
That's just the truth. So anybody who tells you they've never made a mistake or had a deal go bad is either lying or they've never done many deals. So the lessons you learn are the ones that you remember, the ones that really from your goof ups. And I've had
Yeah.
plenty. So
Is this your firm, Alex?
Engineered Tax Services is the company that I like to use. This is the first apartment building that I ever bought after taking James and Nicole's class. I was like, I got to do this. It took me about a year to buy one after I took their class. It's a company out of Florida. So so basically they allocated 1.343 million after subtracting the cost of land, 419 plus 74,000 ended up being the upfront depreciation. So it ended up being 493,000 out of 1,343. So it was 36.7%. I was able to write off in year one, and I just wanted to show you what you get by paying $5,000, $6,000, $7,000. 150 pages of, I'm sure like they plug it into software, but you get all these tables of what goes in to the property, like concrete, masonry, metals, woods, plastics, finishes, specialties, fire suppression, plumbing, integrated automation. I don't even know what that means. Communications. No idea, but they make a very nice looking study that you give to your accountant. And a lot of tables, a lot of information, like how many square feet of interior doors do you have? What kind of paint is on the doors? I don't even know, but it looks legit. And you attach it to your tax return, and then you get a nice deduction. So I wanted to show you what a sample report looks like.
When we're finished, can we kind of,
Sorry, can I have a question? So do you normally do this, Alex, with this, and then you have your tax accountant do the rest for you? So you do this part and then they do that, or you give them this so they can do it for you, or combination?
No, I hire a separate company. So I hire engineered tax services to do my cost seg report. And then I give it to my accounting firm and I say, hey, I bought this property. And because of that, I want my 419 plus $74,000 year one deduction. And they figure out where to stick it on the tax return.
Okay, and then if you said this, I'm really sorry. I probably wasn't paying attention. Do you normally can I do this cost segregation at any time? Can I do cost segregation at any time, or
You can do it at any time, but after you've owned a property for like 10 or 12 or 15 years, you might have already depreciated a lot of it on the straight line 27.5 year basis. So if you've owned a property for a really long time and you've depreciated a lot, the remaining depreciation is lower than you can take. But I'd say if you bought it in the last 7 or 8 years, it probably still makes sense to do. You just have to run the numbers to see what your current basis in that is.
Okay. Yeah. Okay. Perfect. Thank you.
Let me know if that makes sense. Thank you.
can we go back to the very last slide, maybe?
Yeah. Oh, this is very last slide, very important. So
Well,
Nicole and
Go
James,
ahead and
I'll let you guys
go ahead and go back because
Okay.
if they have questions.
If you guys have questions, I put my cell phone number and my email here, or if you need to buy or sell real estate in the DMV, I've been doing it for 24 years now. Happy to help you out or answer any questions. That's my little plug for my real estate sales business.
And he's a great guy. He's a great guy.
I don't know, but I learned a
Known him,
lot.
known him
Nicole
for
and
quite a
James,
few
I'll
years.
say that. Thank you.
He's
Nicole.
questionable sometimes.
I'm very questionable, but I like it that way. You gotta have a little bit of a, you can't be too good. You gotta balance it out with a little bit of evil.
He's a good guy.
Alex, can you repeat the audiobook you mentioned?
Oh, yeah, this book is awesome. It is called and I think they also have a paper book, but I listened to the audiobook. It's called The Book on Advanced Tax Strategies. I don't know if you can see my phone. It's
Yeah,
like
I found that.
bluish.
By Amanda Hahn and Matthew
Yeah,
McFarland.
by Amanda Hahn and Matthew McFarland. And it's totally worth whatever the price is on Audible. But I figured out that if you buy audiobooks on Amazon versus Audible, even though they're the same company, a lot of times it's a little cheaper on Amazon than buying it directly on Audible. I don't know why, but take a look at that. Usually I save a couple bucks by buying an audiobook on Amazon for whatever reason.
Okay,
And I'm
thank
cheap,
you.
so every $2, $3 that I save, I feel like it's a win.
Yep, every penny counts.
Yeah, thank you for asking that. That's one of my favorite like it's one of my it's not a super long book, but I learned more. It was like a nice refresher course on taxes, and it wasn't super boring. It wasn't as dry as most tax books.
Oh, okay, that's good to know.
Nicole, should I go to the next slide?
Sure.
All right, I'm gonna let you guys knock this out of the park.
All right. Well, you're a much better salesperson. You and Joanna are the two sales geniuses of this group. But so, and actually, I want to say thank you, Natasha, for joining us in our group. Hopefully, we can make a difference in the outcome. But I have been doing real estate for 30 years now and teaching for, God, 15, 20 was going on. Um, and over that time, I have learned a lot of hard lessons. I've learned a lot of tips and tricks and wanted to really try and share that with people. And so we put together basically a 36 module online course that you can do at your own speed that talks about things from how do you find the markets to invest in? How do you analyze a property, make offers, raise money, manage the property, and then manage your business? So, what I have said for a long time is that what people want to learn is the acquisition part. How do you find the markets? How do you buy a property? But the reason properties don't close is because you can't raise the money. People aren't good at raising money. And the reason properties don't gain in value or people lose the properties is because management is not effective. In the long run, in my opinion, management is more important than buying. You need to buy right, but if you don't manage right, it's all for naught, particularly in longer term investments. And so that's why when I decided to put this together, which is what, 15 years now, something like that, I've been teaching, I really included not only acquisitions, but how do you raise money right, correctly? How do you do syndications? What are the rules for raising money? And then how do you manage property managers? Because unlike Joanna and Alex, I have never managed my own properties. I had a more than a full-time job and I wanted to buy more, so I had to get good at managing managers. And that's what we talk about in this course. And I guess I would ask Alex or James or Joanna. Alex, well, James, what would you add to this? You're doing more selling and coaching than I am on this, and what makes a difference to you in all this?
So I think that the reason that this course stands out so much, obviously we've got proof, right? We got Alice, we got Joanna, got myself, Natasha just joined. There's a couple of other people on here as well. But the one thing that I continue to hear from students and people that actually take action over and over again is the level of expertise that you bring to the table, Nicole, and the genuineness that you bring, the clarity, the transparency, and just the way that you teach allows individuals to really grasp the information and go and do something with it. There's not a lot of hype. There's not a lot of, fast talking or anything like that. It's just good, pure information. And it's basic fundamental principles. It's stuff that you can apply 30 years ago. And a lot of the basic principles still apply today. So they're just timeless. And I think being able to present that in a efficient, effective way, people really seem to appreciate it. We've had a 30-day money back guarantee on this thing ever since I took the course, and I've yet to have anybody actually ask for it back, feeling they didn't get immense value out of the course. So at the end of the day, it's all about compressing the learning curve, right? You can learn this stuff on your own. There's a ton of stuff out there. It might take you a long time,
Not to
and
this
you're probably going
extent.
to
I
trip
mean,
a bunch of
there's a lot of
times.
crap out there on YouTube and whatever. Like, I don't think you can learn this stuff on your own.
So,
I disagree
right.
with it.
Well, I mean, it would take you a long time. You probably make a lot of mistakes, and you can lose a lot of money. I mean, look at this guy that just lost 15 million, right? So, I think it's easily probably the best use of an investment if you want to get into multifamily or mobile home parks or self-storage and be successful long term. So I'll just kind of leave it at that. But Alex, what else would you add? Or Joanna?
Yeah, I would like to second on what James is saying, and then also too, I don't know if they said it, but Nicole is extremely humble and very conservative, and she is a plethora of knowledge. I invested before buying their course as well, even though that I'm bought their course and am a student. I also invest, right? Uh, I bought a $20,000 course, which to me, I've learned so much more from this course than I did with the $20,000 course that I paid. And yes, of course, you learn from other people too, and you expand your network. But I think that if I wouldn't have taken this, I wouldn't have excelled 10 times faster than spending $20,000. That I couldn't have used those 20,000 towards a property and or even invest it with the team. So I highly recommend it. I'm not just saying that. Yes, I can be in sales, but honestly, like it's genuine people really giving back, and she really pours in. Even though she says that she doesn't want to do this, she continues. So,
And you get to be part of the community too, right? So which is
yes.
awesome.
I'll
So
say this.
yeah.
I took a class in 2017. I've probably gotten well over 1,000x return. What is that percentage? 100,000%
A lot.
return information. And I haven't really paid much, if any, federal income tax since 2018 because of this. So I owe my life to Nicole and James in a very big way. And I would never have been able to scale from buying my crappy individual rentals to something more meaningful. It gave me, pardon the language, it gave me the balls to go out and buy my first apartment building. And I just
And
put an
you
offer in on my seventh or eighth building a couple days ago.
and you just bought two buildings not too long ago, two multifamily properties, what, within the last year?
I bought I bought a 41 unit and an 8 unit. I bought a 41 unit in March. I bought an 8 unit, I think, in February. I helped my friends buy a 40 unit in January that I'm helping manage. And I just put in offers on a 46 unit and a 20 unit in the last week. Hopefully the 46 comes through.
Way to go,
We're gonna
Alex.
scale up, baby. We're gonna
Nice.
Yes,
scale
you
up. But
are.
I mean, I owe all this to Nicole. I wouldn't have had the balls to do it without
Let's
Nicole.
go.
I think 100%. I mean, like this is if she charged $300,000 for the course,
And nobody
I
would
went back
buy.
in time, I would have bought it.
Well,
No
maybe now.
question.
So you
Because you
guys
got to
are
do
all,
it. You got to do it. You can't just look at a course and put it on your shelf and forget about it. If you don't do
right.
it, then you're wasting your time and money. If you actually follow through with it, then yeah, you'll do excellent. And I probably read every book that you can find on Amazon on buying apartment buildings and, watched all the videos on YouTube and all that. And none of that information is I mean, just the little tidbits that she taught me about incentivizing property managers properly, like even that's probably made, over $1 million difference. So thank you. I owe my life to you guys. I really appreciate it tremendously. And my kids will appreciate it too once they realize the gift that they've gotten.
So I guess I really appreciate all of you guys saying that, but I want to say back, the way you are successful in this is by doing it. So I and James can put the information out there, but if you don't take it and use it, then you just don't go anywhere. And so it is persistence, and it is actually doing the work that makes this work. And so, in my opinion, the credit, the majority, the biggest credit goes to you, Alex, and to you, Joanna, and James for actually doing this. People make information available all the time, but you have to take the information and then do what it says and keep at it to
And
make this
Nicole, you
work.
gave us the tools. The tools are very important. You can't accomplish much without tools.
Yeah,
You
okay.
provided the tools,
I
so
think
thank you.
I think we're gonna never agree on who the majority of the credit goes to.
I mean, I could spend my time doing something, but you gave
Yeah.
me a good path, so it was
It's
fantastic.
after 8:30, so we probably need to wrap this up and not hold everybody.
Well, listen,
So
everybody.
what
Like,
so what is our next call? When is our next call, James?
all right, so going forward, it is every Tuesday, every second Tuesday, and every fourth Tuesday of the month is when we'll be doing these. We'll send out a schedule of what we're going to be talking about over the next couple of months here in the next few days or so. So keep an eye out on your emails. If you have any questions, you can always reach us either at support at Passive Cash Flow for Life, or you can email me directly at James at Passive Cash Flow for Life. The QR code on here goes directly to the course page, or obviously you can just type in passivecashflowforlife.com. Thank you so much for attending, Alex. Awesome.
You
Fantastic
you did
presentation.
a
Really, really
fantastic
well
job.
done.
Thank you very much for the
Good job,
opportunity,
Alex.
for letting me practice my PowerPoint skills.
You
You
did
passed
good.
100%. A plus. All right, guys.
Thank,
Have a great night.
thank you
Good
for the
seeing everybody.
opportunity.